I should not get an insured mortgage. So anytime you have to you're putting less than 20% down, you're going to pay CMHC or Genworth or Canada Guarantee a premium for the mortgage to insure it. Who does not want to pay that? Or who has bought a property with less than 20% down? Yeah. And you have to pay the mortgage, the insurance on it. It's not a small amount. If you, with 5%, you have to pay 3.6% as a premium, which you'll never get back. So you might be thinking, well, why should somebody do that? Well, I'll show you. So if you had an option to buy a property where you're going to buy $400,000 property, and your down payment in that situation, 20% down, is going to be $80K, and your mortgage $320, your mortgage payment is roughly about $1,200. So over the course of 5 years, there's no cash flow. You're basically every month giving money out, right? As there's a mortgage pay down, but that's from you, okay? There's appreciation of 2%. So at the end of 5 years, you're going to gain, you're going to gain 7,000 net. And kind of your return is about 8.85% in 5 years. So that's like a percent something a year. Is that a very good return? No, right? So there's another way. So let's just say we're going to put 5% down instead, okay? Assuming that you can qualify, we're going to put 5% down. So our down payment is only going to be $20,000 to buy the home, okay? So bigger mortgage, pay the insurance premium, bigger mortgage payment as well, $500 difference. So even more capital outflow from a cash flow perspective, okay? Mortgage pay down, and then you got appreciation. So in 5 years, you're actually down. You're losing about 10% because everything's been going out. So where am I heading with this? Where I'm going with this is we're actually going to, with the remaining money that we have, that $60K, we're actually going to buy our property instead. Okay? We're going to buy a $300,000 property, and we're going to have a mortgage payments, you're going to have your rent, and you're actually going to have some cash flow from it too. Okay? So even in, you're going to have $200 cash flow in this situation. So you're going to have mortgage pay down, you're going to have your appreciation, and you're actually going to get 120% in 5 years from that property. So when you average the two, you combine them together between these, you've got a total value of about $700,000 in terms of the purchase price, as well as a bigger mortgage, but the amount that you use for down payment is still $80K. And through the process, as you combine everything, you're actually ahead further by $70K in 5 years' time, just by having that rental property in the portfolio. So your return is close to 88% versus 9% in 5 years. So this is a good way to approach it.
Thanks guys for watching my video. Please subscribe and share with your friends. Email me if you have any more questions. Thank you.